Hey, this is Awais with EminiPlayer.net, and this is a recap for Monday, June 2nd. So heading into the day, we had pre-market support, 16 quarter to 1875, and we were opening near Friday's high. And given that we had important econ data at 9 a.m. Central, the plan mentioned that a continued upside push was the lower odds scenario, and the risk was on the buy side off the open. So a pullback to the gap fill at 20.5, and the pre-market support zone was more likely ahead of econ rather than the flip side scenario of just continuing higher and just making yet another all-time high ahead of important econ reports. Bigger picture, the bias was still bullish, but short term, we knew that the econ reports could trigger a move lower as far as down to even the 0875 to 1075 initial support zone. We had a naked VPOC at 1912, and then we had support at 1914. So all of those levels were potential downside targets in the event of a negative reaction to the econ report. And on the short side, we were only going to consider shorts if there were some very clear signs and there were good indications that we were heading lower. On the upside, we wanted to still be defensive if we were buying a bit high, but on the pullbacks into support, we would look for long setups. So that being said, let's jump into the charts. So we can see that opening near Friday's high and actually even a little bit above it, opening outside of value, heading into important econ reports, we get responsive selling off the open, and we essentially get an open drive lower from the open down to 21 quarter. And if you were watching TF, there was actually a lot of weakness in that market. In the first 10 minutes, TF had already broken below its overnight low, and in the overnight session, it had held below that 37 to 39 resistance, so we knew that there was that relative weakness already in play. But then off the open drive and the break below the overnight low really confirmed that relative weakness in TF. If you were watching NQ, pretty similar idea. Within the first 15 minutes, NQ had already broken below its overnight low and was continuing to show a lot of selling pressure. Same thing on the S&P, except we have to keep in mind that the S&P is the stronger market, and for that reason, even when you're shorting the S&P, you do want that ideal trade location. You do want to time it a little bit better than the other markets because the selling pressure can sometimes take some more time to play out. So off the open, we get this open drive lower. Internals are heading lower. The other markets are looking quite weak, especially TF. And given how weak TF was, buying was out of the question. This was the first time where we were seeing some pretty decent momentum on the downside. So the first setup is actually on this bounce back up towards 22.5 to 23. We had the overnight VPOC right around 22.5, and this bounce back into it after the open drive and the tick heading lower and the other markets showing weakness, the first setup that we get. So the ideal location is 22.5, and on the downside, you're looking for, at the very minimum, a pullback down to the overnight low, to the gap fill. But ideally, you want this market to go down into the pre-market support zone, and then that's where you look to cover. So the trade idea is short 22.5, targeting roughly 1675-17 area, and that's still a very conservative setup. It's not looking for a very extended target. And if you're in at the right price, then that allows you to hold into the econ release, right? So for example, if you missed shorting it at these higher prices, and even 21 quarter could still be considered a decent short, and you could put your stop above 23, but there is a little bit of risk that you could get chopped up. If you're in at the high price, now it's a pretty safe setup because you can put your stop at the overnight high, and it's very unlikely that given the negative internals and the weakness in the other markets, that S&P is going to make a new overnight high or push even to the overnight high. So this is a conservative trade location idea. Over here, it's a little bit more aggressive. If you're taking this, you would have to put your stop right above 23 quarter, because at this point you don't want this market retracing back up here. You want that open drive to remain in effect. We come down, 19, get a little bounce. Now econ comes out, and we get that nice big push down to 1375. 14 quarter was the overnight low and low from Friday, So at the very minimum, you do want to take some profit, and at the very minimum, scale out of your short if you took it early in the morning. And if not, then this bounce back up is an opportunity to get on board on the short side. Because the way the market was playing out, considering how weak the other markets were, I mean, TF essentially broke below its recent, 3 to 4 day balance, and there was a lot of momentum on the downside. So given how the market was shaping up in real time and how weak the internals were, um, it made sense to expect a tag of the 1912 naked VPOC. So when this bounced back up, this is still another short setup. And in this case, it is a little bit more aggressive. And keep in mind that, on the short side, we are playing defense, right? So we're considering shorts, and this is really the only scenario where it made sense to short, but we are going to play defense. That means that this trade idea does have to start working out relatively soon, and we need to break some of these lows around 16 quarter, right? Now, once this comes down and it takes out this recent low and doesn't really go much lower, that's a red flag, right? Because now you've balanced in this range for quite some time, right? You can see we bounce here back up to the VWAP on the RTH chart. And at this point, if we are going to make a new low, we need to push below this 1575 prior swing low, 16 quarter. We do need to push below that. And you can see over here that we get this, decent momentum bar on the downside, about a minus 700 tick reading, and then the market just goes sideways. That's not what you want to see, right? When you get this kind of momentum to the downside, and if this is really a bearish market, then this should just continue. It shouldn't be heading lower and then just going sideways, and the tick you can see goes back above zero. Over here it actually holds zero on the pullback, right? And then continues heading higher. So over here, once I saw that this market could not break below 1575 and hold below 1575, and then now it was just going sideways, and despite the minus 700 tick, despite all the signs that indicated that this market should go lower, it wasn't going lower. So I knew that this was still that resilient market that we're in, and I ended up covering my short position right at 17 and looking for the next trade. Now, I still didn't trade it on the long side because there were just too many signs in real time signaling that this was a weak market, right? In the trade plan, I mentioned that if we break below pre-market support, that would be a sign that we're in a weaker market and there could be limited upside. And for that reason, I did not take any long setups today. Even though this around 14 seemed like we could get a decent bounce, there was just too much momentum on the downside, and I didn't want to buy it at an aggressive price. I wanted to fade this move if it had gone down to like 1912 or ideally into initial support. That would have been a really good fade setup, and I would have traded it from the long side. But because it didn't go all the way down there and it bounced at 14 and then still looked like it had one more low in it, I stayed out of the long side. The next trade idea was another short on the push back into this overnight balance, right? The overnight balance was roughly like around 22.5 was the overnight VPOC, and you have the IB high, opening range high 23.75, overnight high 24 quarter, and there was a very clear negative divergence on the NYSE AD line. So as price moved back all the way towards almost a high of day, the NYSE AD simply pushed back from minus 1,000 up to zero, right? And considering that S&P is at all-time highs, it's unlikely that we're going to get a push above the overnight high and make new highs when there's such a big divergence on the advanced decline line. And even in absolute terms, it's showing a relatively mediocre value, right? Around zero, mostly below zero. So I did short the market again on this pop up to 23. And then I just kind of sat through this chop, right? There was a lot of sideways movement. That negative divergence was still in effect. And on the downside, I was targeting a move to 18.5 to 20.5. And the stop on this trade was 24.5. So it's a fairly tight stop idea. And, because of that, you don't need to get a huge move in order to get good reward to risk on your trade. So as it came down here, after balancing in a range for quite some time, if it was going to break, very similar idea to what I mentioned over here. if it's going to break, then this is the time that it should go lower. We had a pretty decent tick reading, I recall. So let's just kind of scroll over and check it out. And you can see over here that we actually get a minus 834 reading on the NYSE tick. So, if the market's going to go lower, this is the time. When you're getting those massive tick readings, that is the time where you should get follow through. And if the market's not doing what you expect it to do, then that in itself is a red flag, right? So once we came down there, and again, we couldn't take out this, 20 half, 20 area, despite the minus 800 tick reading. Again, I just covered the short, right, for a small gain. And at that point, I just called it a day because from that point forward, there really wasn't much opportunity. It was just sideways balance. At that point, I no longer had conviction on the short idea because the market had shown me that it was just holding up extremely well. And these negative divergences, sometimes they don't resolve, until the end of the day or sometimes even the next day. And the other thing is that the advanced decline line is based off of the prior session's close, right? So that's how the advanced decline is calculated. It's based on how many stocks are trading above or below their prior close. And that's how you get the difference between the stocks that are trading above and below, and you get the advanced decline reading. So as the day goes on, the prior session's close becomes less significant, right? So that's the other reason that I decided to cover the short setup and just call it a day, because as we head into the afternoon session, the negative divergence doesn't have much meaning anymore. Even though that divergence might be there and it might persist, it is just not relevant, right? So as the day progresses, the advanced decline line and the divergence on the advanced decline line just has less value. It just doesn't mean much anymore because now you're approaching the next day's close, right? So just inherently, it's not going to have the same pull or the same significance that it would earlier in the session. So once we saw that big divergence early in the morning, it made sense to short the market. But once the buyer stepped in at 20 half, which was like the top of the target zone that I was looking for, and despite the negative tick, they couldn't push it lower, that's a good sign that this market is very resilient and you don't want to be caught on the wrong side. And I just lost my conviction on the short side there, so I covered the trade, and that was basically it on my end. I didn't look for any other trades, even though I thought there could be some edge on these pullbacks because the market was just holding up so well. I didn't have enough conviction even on the long side to take any trades, and it was just a lot of sideways balance and chop. And you can see we just stay range bound and build a lot of volume around the 22 to 23 area over here, and nothing really happens. So it's important to realize when there isn't a lot of opportunity in the market and simply stay put, right? Don't put money at risk if you feel like there's not going to be enough reward to really justify it. And you really only want to trade when the opportunity is really there. The volume's there, the momentum's there, the setup's there. You're getting good trade location, you have good reward to risk. When everything lines up, that's really when you want to press and hold on to the trade. But in this type of market, where the opportunities are kind of few and far between, and if you miss it, then because the volatility is not really there and the ranges are relatively narrow, it becomes difficult to take advantage of anything else beyond that. So at that point, you really have to protect your capital and save your ammo for the following session or for the next good trade idea. So that's really how the session ended up playing out. At this point, we're still seeing pretty big weakness in Russell, and this is a red flag. This is a warning sign for buyers here. And heading into tomorrow, we're going to be watching roughly this 2175 to 2375 area, right? Or 22 to 24 even. And we're going to use this as a very key resistance or bull bear zone idea. If we continue to hold below this 22 to 24 zone and the other markets continue to remain weak heading into tomorrow, then we could still get a downside move tomorrow, right? This is really the first time in the last 5 to 6 sessions where we've seen some pretty decent weakness in the underlying, in the broader market. And we've seen a kind of a lack of that strength and broad market participation. So at this point, we do have to be careful with long setups. And on the downside, if we, hold below 22 to 24 and then start pushing below the 18 to 20 area, then that would confirm the downside momentum, and we could still get a move down to 1912 and 0875 to 1075. So then those zones would still be in play. If we break above 22 to 24, then it would tell us that buyers are still very much in control, and we could get a breakout then again to a new all-time high. But below 22 to 24, I think you do want to be careful on the long side because there could be some limited upside here. TF is, a big warning sign right now. It, broke below its recent balance and then actually closed below it as well. So if it stays below, the 1128 half to 1131 area, that'll be a problem sign for TF. And if we continue to see weakness there, then S&P will likely have trouble going higher too, and we could get a pullback here. So we're finally seeing a little bit of warning in the market for buyers. So let's just take that into account in the overnight session heading into tomorrow. Let's see how well the buyers hold it up. Let's see where we're trading in relation to 22 to 24, and I'll update you guys in the morning.